got some other things that you can invest into that will further reduce that tax, but you will pay that tax. But the key is that whatever you invest in inside of the opportunity zone after a 10-year hold, no matter what the amount is, that you get to exit it completely tax-free.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. Again, really excited about this episode because I'm talking with Ashley Tison over at OZPros. And we're talking about a really cool strategy for deferring or eliminating capital gains as an investor or somebody raising capital. So this is really, really huge. If you are in that mode of, I'm going to raise capital, I need money for my business, and I know that I'm going to make a lot of money in the long run, well, guess what? One of the best ways to entice investors is saying, hey, our investment is going to be capital gains tax-free. So that's going to save you a ton of money. All right. It's also going to save you as the issuer, the capital issuer, the capital raiser, a lot of money down the road as well. So make sure you watch this entire episode all the way to the end, check out the show notes, and get the links that you need to make this a reality for you. So as always, like, subscribe, and share, and looking forward to seeing your comments about this episode.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm joined today with Ashley Tison from OZPros. Ashley, how are you?
I'm fantastic, Jeff. Appreciate you having me on the show today.
Absolutely. I'm really looking forward to this. I know that our company's been working with yours in that capacity to help somebody set up an opportunity zone fund. And we're definitely going to get into that. Before we do, why don't you talk to folks? So tell us a little bit about who you are, your background, and how you got to where you are today.
Yep. So I like to call myself a reformed attorney because I stopped practicing law because I wanted to get in the game. I left law. I actually have been an attorney, a licensed attorney for 24 years and still am licensed. And so do a little bit of the legal crossover in the context of some of the consulting that I do, but kind of had a long and various history. I started out as a big firm attorney, and after it sufficiently sucked my soul, decided that I wanted to get into more impact investing and impact type arrangements. And I set up a impact investment company at the same time as I went in-house with a commercial real estate tenant in common syndicator. So we bought the shopping centers by the gallon and syndicated them to 1031 investors by the scoop. And I learned about how to distribute real estate securities through a broker-dealer network. And when the financial crisis of 2008 happened, I left, basically went out of real estate and went back to practicing law, built up a mergers and acquisition practice where we helped, Main Street America do Wall Street level transactions. And it was all types of M&A type stuff from folks that were exiting, blue collar businesses to roll up transactions. And as I went down that road, I saw people leaving a ton of money on the table. And so I sold that practice specifically so that I could do consulting on how to help entrepreneurs put more money in their pocket, because it's not about what you make, it's about what you keep. And started a consulting shop doing that, and found out about these things called opportunity zones back in 2018, and literally have been doing opportunity zones ever since. Because when I found out about them, I was like, man, that's like private equity and 1031 got married. And it was a fantastic, kind of juncture of my experience. And when I said that to the guy that was telling me about them, he said, yeah, and they had a beautiful baby named Opportunity Zones. And so that's what we've done. We've tried to bring that same level of Wall Street level sophistication to Main Street America to put the power of this economic incentive into the backbone of America's economy, to give them the same, tax breaks that the big corporations get. And it's been an exciting run. Yeah.
Yeah, I bet, man. So that's really cool. All right. So you have a lot of history then when it comes to a number of different types of transactions, like you're saying, doing real estate. And what do you mean by working with commercial real estate, multifamily real estate with the broker dealer world? Like, explain that, because that's a new kind of take on it.
Yeah. So we put together funds, and we were a TIC sponsor, so we had tenant in common funds that we had that were available, and we would sell those tenant in common interests to people that had 1031 money, but that didn't want to go and do their own property. And so we would put together a spot where we had 35 tenant in common folks. We go out and we buy a like a Class A super center. Whether it was a Walmart or a Food Lion, or we actually bought a bunch of enclosed malls. We bought a hotel, and we, put it together. We brought in CMBS loans, and then we had a tenant in common slot. And because it was a security, we were able to market that security to the broker dealers who had clients that had 1031 money to place. And we actually had a really great national network of broker dealers and RIAs that would market our products to their clients that wanted to come in and do a 1031, but didn't want to have to manage it themselves. Or they wanted to get in on a Class A deal, but they didn't have, they had $100,000 or $300,000 worth of 1031 money. And so that's kind of the same approach that we've done in the context of the fund that we've built for doing opportunity zones.
That's awesome. That's really cool. So I have one question. It's a little bit off topic, I think, but I'm very curious about this. When you're working with the RIAs and the wealth managers or whatnot, and you're doing 1031 exchanges, generally you are rolling all the money from one deal into another deal. So with a lot of these wealth managers, they'll be taking asset under management fees and things like that. And sometimes, in the broker dealer world, it's transaction fees. How are you able to actually pay those fees to those people? If you're trying to do essentially, phantom income or a rollover, so that there's no real, taxable basis or money being, put on the table for them.
Yeah, it's fascinating that we could actually pay BD fees out of the 1031 money that they were putting into the deal. So we baked that into the transactional costs. And it was really fascinating because we actually had a 10% load that was in there for every person, because, we'd end up having to pay a supervising broker dealer for us. We'd have to pay the managing broker dealer that was running the transaction for the placement agent. Then there was usually like a selling fee in there as well. And then the actual agent, the broker dealer, they usually wanted between like 6 and 7%. So by the time you stacked all of those on top of each other, it ended up being around 10%. And so if somebody came to us through there, we would pay that fee through our managing broker dealer to their broker dealer, and then it would get disseminated. If somebody came to us without a broker dealer, if it was like a direct one, we would gross them up. And so for every dollar that they put in, it was really 90 cents going into the deal. So if they didn't have a broker dealer, they would technically get $1.10 worth of capital account in our deal.
Got it. Yeah, that's smart. I was just curious about that because that's a really interesting take. That's why I was asking about that. You don't hear about that too often unless you get to a really large level, right? If you're doing in the tens, hundreds of millions of dollars and beyond, then I guess it makes a lot more sense that way. And those people are not as worried about 10% fees because of the fact that, well, it would have been either been that or 20% capital gains, right?
Correct.
So it still saves them a lot of money in that regard.
Well,
so
it allows
that's very cool.
It allows them to participate in a syndicated deal that they would otherwise probably not get access to.
Right.
And so there's a lot of people that do that, go through kind of a financial advisor or a registered rep or an RIA, and they, that's how they get access to these deals. And inside of that, there's an extreme amount of due diligence that the managing broker dealer and the other kind of platforms do in order to get people comfortable that placing their money into a deal is that. And it justifies the fees, or in their mind, it justifies the fees. I mean, I saw a bunch of those deals go south, notwithstanding the due diligence that the managing broker dealer did. Right. And I saw a bunch of deals do really well that didn't have any kind of managing broker dealer or any kind of fees that people could get direct access to. And I think that that's the cool thing about what you guys are doing inside of your angel investment network is that you're allowing private investors to come into these companies where they're not having to pay that load. They're getting deal flow, but they're not having to pay that load. And so, and then maybe as the companies go up and they go to that next round of capital, it might make sense for them to look at, okay, hey, listen, on this, next round, it makes sense for us to go through the broker dealer network and to, and to justify the additional due diligence and all of the other fees. But, it, once again, kind of that Main Street level, you typically don't have the ability to be able to pay a load out of it because the deal's fairly skinny because you need all the money in order to be able to make the deal work.
Right. Yeah, absolutely. Well, and then you talk about going from the real estate side and the tenant in common aspect all the way into M&A and doing these M&A deals. And so, that's another really unique place. We're helping companies and folks go in and invest in these private equity, small middle market deals.
Yep.
And it's just a really unique space because there's so many people that are retiring that want to be out of it. And
Silver
I
tsunami.
oh man, it's crazy. And the blue collar businesses are the best ones. Like bread and butter, really boring, but really profitable, right?
Absolutely.
And there's some of the best opportunities out there. So now that's very cool. Love to, pick your brain more in the future on some of these deals we're working on, but.
Well, we could talk about it. So I've actually, and in the context of the opportunity zone work that I do, you're talking about blue collar. This is kind of a case study on how you can use it. We're putting the cart before the horse, but hey, let's do it.
Yeah, we are, but let's do it. Let's do it.
So we had a client. He had a capital gain from I think it was appreciated stock that he sold. We also had another business owner, and he wanted to get out of one business and he wanted to transition into doing other businesses. And so he actually bought some real estate inside of an opportunity zone. He built a flex industrial center and he turned it into a blue collar incubator / accelerator. So he opened it up to plumbers, electricians, folks that, served different kind of home services type deal. He started an accounting firm right in there that could run the accounting and the bookkeeping for these guys. And then he also had like a call center that he placed inside of that same building. And so he had these additional services, which made him a much more attractive landlord to these folks. And then by utilizing their services and helping them out, he was able to look at their numbers, see who was actually good. And then he was able to use his fund to make lead investments into these guys to help them get past that kind of 3-truck glass ceiling and be able to break into the next level. He got a seed investment for doing that. And then he was able to package them up and then, roll them to PE that, once it got kind of across that $2 million EBITDA threshold. And so it was really kind of an awesome, collection of bringing all of these things to work. And he positioned that so that not only is he not going to pay any capital gains taxes on the growth of the value of the real estate, but he's also not going to pay any capital gains taxes on the growth of the value of the companies that he's investing in as well. So kind of cool to be able to bring all of that together.
That's huge because we look at deals regularly. And it's really funny. We're, helping company or people acquire different companies as part of a roll-up strategy or bolt-on. And sometimes we're on those calls with the sellers and the conversation will come up like, okay, so how much cash do you need at the end of the day when we're buying this? Oh, and they'll tell you what their listing price is.
Yeah.
So okay, so that's great, but you're gonna have to like pay taxes. And then we had one guy who said, no. When you buy this business, we've already paid all the taxes, we've already paid all the debts. You're getting a debt-free, great business. Like, no. You're going to be paying taxes when you sell this company. Like, you understand, so Uncle Sam's not going to let you just take all of it and walk away, right?
24%.
And I tell you, they really don't understand it. They don't understand that there is a capital gains issue. It's not as high as maybe the W-2 tax rate, but it's still a decent chunk of change if you don't structure it properly.
23.8%. And you're going, and that's just the federal, let alone the state. And so you really have to factor that in because once again, to your point, it's not about what you make. It's not the listing price. It's what your walkaway price is going to be. So first thing, you got to pay the brokers and the professionals that you're going to have, right? And so there's going to be fees, and those fees, they're not going to be outrageous, but they're going to be fees. And then you got to pay the taxes along the way as well. And so that's where we've really come alongside of business brokers and real estate agents and that kind of thing, right? As, our economy has hit a little bit of a hiccup and, those multiples have kind of, shimmied down a little bit and the cap rates have kind of come up and said, hey, how can we get creative in order to be able to put the same amount of money in your seller's pocket as what they would have, right, without this, advantage. And so by utilizing opportunity zones, we've been able to defer the taxes until 2026. We've been able to help them with some other mitigation strategies along the way that can minimize those taxes when they have to pay them. And then we position them so that their new investment inside of the opportunity zone completely eliminates those taxes. And so it's been a difference maker and sometimes even a game changer that actually allows skinny deals to get done that otherwise would not be able to get done because of us being able to kind of shave that tax dog.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah, that's awesome. And, I love being in the financial services world the way that I am because I get to talk to guys like you and hedge fund managers or private equity folks and venture capitalists, and then folks that have exited businesses, people that are investing in businesses. And I'm never, at a loss for new information, right?
Yep.
And so learning this stuff it is so much fun because, like you said, it's not about what you make, it's about what you keep, right? Unless
That's right.
you want to just give everything away, which is totally fine, but I would rather go to a nonprofit than the government, in my opinion.
Well, that's one of our strategies, right? We've actually got a really cool strategy where you can have a charitable element of it and you can basically eliminate taxes through that. So there's a lot to be said for that.
Well, let's get into this more because we've talked about this word opportunity zone and opportunity zone funds and what is it? Where did it come from? And then we can go in a little bit deeper.
So opportunity zones were created by the Tax Cut and Jobs Act of 2017. And Congress, in 3 pages of legislation, were able to, number one, get the attention of private capital. Number two, get capital off of the sidelines. And number three, make it patient. And they did so by 3 separate incentives. First is that they wanted to pull capital out of kind of traditional markets. So they made it so that any kind of capital gain had the benefit of going into an opportunity zone. The second thing is that they gave you an incentive, an additional tax break if you got it in during a certain period of time. That benefit expired in 2021, which is why a lot of times people are like, well, hey, I thought that opportunity zones were already done. No, just that one benefit, which if you look at it as a rounding error compared to the big benefit, which is if you hold your investment inside of an opportunity zone for 10 years, you get a complete step up in basis to fair market value, which eliminates capital gains and also eliminates depreciation recapture. And so,
all right, so really quickly on that one, just so anybody that may not understand this, let's use an example of numbers. So first off, it has to be the capital gains you're making. So let's just say I invested in Apple stock, it was $100 a share and I only bought one Apple share. But then it goes up to $300. So I have $200 in capital gains.
Yep.
And normally if the long-term capital gains, 15, 20%, 23 point, whatever percent after
23.8 if it's over 500,000, correct.
So now I take that 200. And if I were to invest in an opportunity zone, if I leave it in there for 10 years, no matter what it grows up to, that 200 could go into 2 million. But I can then say, hey, it's been in there for 10 years. I don't pay any taxes on all of that gain.
Correct.
Are there limits on that?
Now, on the $200, you're going to pay taxes in 2026 on that $200 gain.
Okay.
And so there's some things that we can do between now and then that allow us to get that amount reduced. We got some solar tax credits. We've got some other things that you can invest into that will further reduce that tax, but you will pay that tax. But the key is that whatever you invest in inside of the opportunity zone after a 10-year hold, no matter what the amount is, that you get to exit it completely tax-free. That's right.
That's awesome. That is such an incredible thing. And, I set up a small little angel fund back in 2019. I didn't spend the time to learn about opportunity zones at that point. I'll tell you what, now that we're going into our next round of funding for another fund, we're going to be talking about that. So, because that's just such a huge thing, and I think for anybody out there who's raising capital, you're going to have to talk to us a little bit about some of the nuances here. But why wouldn't somebody want to set up a fund or a structure in a way that's in an opportunity zone that can take advantage of this?
Or if you're starting up a business and you know that you need to raise money, why would you not try to do it inside of an opportunity zone? Because literally,
Right.
there's 5 tests. You have to have 70% of your tangible property be located in the zone and meet a couple of different requirements. And so if you're if you're a business where you got to have a retail location in the hot retail spots, probably not a candidate for OZs. But if you've got the ability to have kind of remote workers check in from time to time and that kind of thing, you are absolutely able to do that in OZs because your workers, 50% of your workers need to work inside of a zone, but that could be any zone anywhere in the country. And so you could literally have people check in Puerto Rico and bam, that counts towards your 50% test. And so
Is that 50% of your W-2 only?
it's if it's 50% of W-2 or 1099, any independent contractors or workers that are involved in the production of income for the business. So your 1099 accountant and attorney, you don't have to worry about them. That doesn't count. So they don't have to be in the zone. But your folks that are actually like producing whatever it is that you're doing, they have to be inside the zone.
Very cool. So, all right. So you said 70% of your property. Okay. So if I were to say
property. So
tangible property,
intellectual property and goodwill and all that kind of stuff on your balance sheet, that doesn't count. You don't have to worry about that. It's like your actual physical real estate that you would own and any FF&E, furniture, fixtures, and equipment, or like vehicles, that kind of thing. They would need to be located inside of a zone. But as long as they're there in the zone, they can go outside of the zone to do business. You can sell your product all across the world. It doesn't matter where you sell your product to. Your inventory and that kind of thing can be outside of the zone. And you could have all kinds of money that's coming from stuff that you're doing outside of the zone. It's just that your personnel and your stuff needs to be inside of the zone or needs to come back to the zone every 2 weeks. And so we've got companies that do that as well, where they'll literally come in and they'll take a picture every 2 weeks inside of the opportunity zone. Here we grow again. And bam, we've got our audit trail that shows that these guys are an opportunity zone business and that they qualify for being able to receive money from a qualified opportunity fund and to be able to give that fund the benefit that after that fund holds their investment for 10 years, that they're not going to pay any taxes on the growth. And so it's really attractive for folks that are trying to raise money because they get a whole nother realm of people that they can raise money from. And then it's also very attractive for founders because they can literally set this up. We just have to have some kind of capital gain and it can be minuscule. But if we start the business with a capital gain through a fund, even if it's the founder's own fund, captive fund, that's our bread and butter is setting those up, then we can make it so that their exit on the back end of this is completely tax-free.
That is huge. Okay. So it sounds like an accounting and legal nightmare to me. To keep track of all those little things. So I would never do that personally. I always recommend, hire someone like you guys to do all that. Because like you said, okay, let's give a theoretical, hypothetical example here. Angel Investors Network helps a lot of companies with raising capital. Yep. And a lot of these guys are starting up and most of the time they're remote, right? They're all 100% remote. But if you had like let's say a WeWork kind of facility and that WeWork kind of facility is in the opportunity zone, and these people came and visited every couple of weeks and did some work from there, could their company then qualify for investments from opportunity zones and be in that same structure?
Yes, sir.
So cool, man. And for those of you guys out there watching this and listening to this, if you've never thought about capital gains and taxes and how much you're going to be paying on that, that would be a really good time to start thinking about that because it's only going to get more expensive. And if you're planning on actually making money, really should be paying attention to how you can keep more of that. So I love this, Ashley. This is awesome.
Uncle Sam is the biggest vendor that we will ever pay in our lives. It will be the number one vendor that we pay.
Absolutely. Yeah, 100%. And I think some people, they don't spend enough time thinking about that and looking at it on their balance sheet or their cash flow statements until a point where they're like, wait, we spent how much? Right. And if there's a way to offset some of that, obviously you're not going to offset all of the tax you have to pay. No one can do all. Well, I shouldn't say no. I'm sure there's some people that figured it out.
We can get pretty dang close.
Yeah. The whole goal here is, like you said, how do we put more of this money to work? And I think this is a philosophical question for certain people, or a philosophical viewpoint, which for me is, I believe in the power of the entrepreneur, the capitalist who is helping to drive and further growth in the economy. I don't believe in the power of the government if we just give them more money that they're going to figure it out, right? Because I think right now, 75 to 80% of all of our tax dollars, income tax, goes to pay for the interest on the debt that we
I was
have
just
in
going to
this
say
country.
the national debt.
Yeah.
Yeah.
And so I really don't believe that the government's doing a great job of being a fiduciary for our money. But I do believe that when there is an incentive for the entrepreneur and the shareholders, the investors, to grow a business that is making a meaningful impact in people's lives, they're going to be much more stringent on how they spend their money, and it's going to go to a better cause over the long term. Would you agree with that?
Absolutely. And I think that the really cool thing about OZs in particular, and any kind of economic incentive program that's place-based, is that in bringing in outside dollars, the effect of that is exponential. I had an economics teacher that told a story about a guy that goes into town and he goes to a motel and he's like, "Hey, I want to see your rooms." The motel keeper is like, "I can't let you do that because I had some people like steal the rooms and like take showers in them." And I was like, "Hey, I'll give you $100. I'll rent your room for $100. And then if I come back within 30 minutes, I haven't disturbed anything, you give me my $100 back." The guy's like, "Okay, I'll do that." So the guy gives him $100. The innkeeper, as the guy's walking up the stairs, hauls out the door and he goes next door to the butcher and he's like, "Hey man, here's that $100 out here for those steaks you cut me the last week." Butcher goes next door to the dry cleaner. "Hey, here's that $100. Dry cleaner goes to the shoe repair guy, right? It goes around 6 times like that. Finally comes back to the innkeeper and he's like, "Hey man, thanks for renting that room to me for my mother-in-law at the wedding last week." Innkeeper's got his $100 back as my guy's coming back down the stairs. He's like, "Hey, listen, man, no offense." He's like, "But I'm not going to stay in that room." Innkeeper's like, "Hey, no worries, man. Here's your $100 back." How much money has actually, what kind of economic benefit has just happened? Right? Is it zero or is it 600? And it's really $600 worth of impact that's just happened as that cycled through. And that's what happens inside of opportunity zones. So not only are you saving money, but you're doing good and you're accomplishing an unbelievably powerful social opportunity as you're doing so.
I love that. So let's go back to this. You said there were 5 things that I believe that the 5 boxes you need to check. We talked about, the real estate, the tangible assets, things like that. What are the other ones?
So the third one is that 40% of your intangible property needs to be used in the trade or business that's happening inside of the opportunity zone. And so it basically means that you can't set up a patent troll and operate it inside of a zone, off balance sheet all of your intellectual property assets to it, and then just collect a check and then sell it 10 years out and not pay any taxes on it. But as long as you're operating, so like if you are, if you've got something where you're doing licensing and your people are working inside the zone, that's totally fine. And that's an easy test to hit if you're not a patent troll. The fourth one is that you can't have more than 5% non-qualified financial property. And that is cash, stocks, bonds, annuities, forward contracts, that kind of thing. So you basically can't set up a stock trading company to own stock and just basically let that stock eat inside of the opportunity zone. So you've got, you can't, have the lion's share of your assets be financial instruments. Now, if you've got a business and you need capital in order to work that business, and you've got a legitimate reason why you need that capital, then that's a safe harbor for that cash. So if inside of your business you need 18 months of working capital, you can set that out of that 5% test. And then the 5th test is you can't be a sin business. You can't be a golf course, a massage parlor, a hot tub facility, or a gambling facility, or do off-premises alcohol sales. So C-stores and like tasting rooms for like liquor, that if you've got liquor where you're selling other people's liquor, that doesn't work. But breweries and distilleries where you're selling your own stuff, that's actually okay.
Gotcha. Okay. So it's always interesting the little things they carve out of these rules.
It's nuts. Golf course, right? It's like, why?
Yeah.
But yeah.
Why would you do that, right? They're like, oh, well, only wealthy people play golf. No, not true.
I get it on the massage parlor.
Yeah, that part I can kind of understand, right? But go back to number 4 there. So yeah, the financial instruments and all that. So somebody can't go and set up like a day trading stock brokerage and raise it like $20 million in their stock brokerage account, then just do a bunch of trading and make that tax. That's not allowed, right?
Correct. And it's, like day traders and that kind of thing haven't been the guys that come to me. The ones that are
Right.
tough are the crypto guys. So I've got people all the time that got a bunch of appreciated crypto and they want to sell some of their Bitcoin and then they want to jump into like other kind of meme coins and stake them or do all that kind of stuff. And they're like, hey, can I just locate myself in an opportunity zone and then do all of these meme coins and then, get the appreciation of all those meme coins that I'm holding and then sell that 10 years down the road and get the benefit. And there's a fine line inside of that. And if you're just staking and doing like holding the Bitcoin or holding the cryptocurrency, that's not going to work. But if you're mining it, we've got an arrangement where we can kind of work the scenario where we can usually make it so that you can actually do that. Or if you've got we actually helped a guy that had crypto ATMs. We helped him locate those inside of opportunity zones. And it's really weird that those are typically located in OZs, right? And I think it's because it's usually folks, converting to crypto so that they can send it overseas. Because I'm like, I walked into this dodgy gas station. There's a crypto ATM in there. I'm like, wait, why is that here? But he was able to locate that in opportunity zones, and we were able to allow him because he's got to hold the cryptocurrency in order to be able to sell it as part of his ATM. And so if you've got a compelling business reason as to why you need to hold it, then that works.
That's very cool.
We've got all kinds of people that are like, oh, I really want to hold this appreciating asset inside of an opportunity zone. And those are typically going to be harder to do. But if you got you just got a locked and loaded business and that business is going to appreciate as you build it, man, that's the opportunity zone sweet spot. And most businesses, like I said, if it's location specific, then we can't usually do that. Or if you, like you've got to make loans or financial instruments, that kind of thing, then that could be a little bit tougher. However, we were able to help a bank. So a bank located inside of an opportunity zone, and we turned that into a qualified opportunity zone business. Actually need to get that in front of your angel investor network because they're going through their raise right now. But I tell you what, it's been amazing the different types of stuff that I've been able to work on. Bamboo farms, all kinds of real estate deals. All kinds of, so we actually had this autistic community where they had a working farm and they were making jobs available to the autistic folks that were part of the community. I mean, it's been really cool to see the huge variety of things that people have come up with that are now opportunity zone businesses.
That's really cool, man. So if I'm hearing you correctly, then there's 2 sides to this, right? There's the investor who is going to invest in something. So we said, the investor wants to invest into an opportunity zone fund.
Yep.
Are there any limitations on where the capital, like if the investor doesn't have any capital gains, let's just say that they had a W-2 and as a result, they've been putting money into a savings account over the years. They have, $500,000. Can they still invest the $500K into the opportunity zone fund?
Unfortunately, they could invest it, but they won't get any of the tax benefit. And that's the one drawback of this program that we would have really loved to have seen them do. I understand why they did it because they needed to cap the amount and they needed to be able to have a limitation on it that they, delivered to the OMB, the ombudsman, to say, okay, this is only going to cost the government this amount of money because we can quantify how much capital gains are out there. So unfortunately, you have to have capital gains, but you can get that capital gain from any source. So it can literally be crypto. It can be stock. It can be business. It can be real estate. It could be appreciated baseball cards. It could be appreciated firearms. And ironically, all of those assets could be things that you could hold inside of your opportunity zone business if you have a compelling business reason around it. So we've set up for-profit museums to hold baseball cards and art assets. We set up a wine, tasting place that had all of these, kind of archived and library wines that they were putting away because they're going to sell them 10 years down the road and all of the appreciation associated with that will be not taxed.
That's super cool, man. Well, I think we could talk about this all day, Ashley, but in the interest of time and so people can maybe go take this offline and go reach out to you guys and your team. How do people find out more about OZPros and you, and where do they connect with you?
Yeah. So if they go to ozpros.com/podcast, we've got special offers in there where they can either set a strategy call with myself or my team. And we've got a discount rate on there for your listeners. They can go to ozpros.com/map if they want to find where the opportunity zones are located. So if they've got a deal, or if they're looking at where they want to rent office space and they want to confirm that it's in the zone, they go to ozpros.com/map and they can, find where the opportunity zone's there. And we're available, right? So if they want to get in touch with us, go to OZPros.com, fill out one of our contact forms, and we would love to talk with your listeners and see if we can make their deal work inside of an OZ.
Beautiful. We will definitely make sure we put all of those links in the show notes. So if you're watching this or listening to this, make sure you check out those show notes so you get access to everything. Ashley, this has been amazing, man. I'm really excited about this. And we're actually in the process of setting up our next one. So we're definitely going to be talking about that, find a way to make that happen.
I'm super excited about doing that with you guys. And I'm shocked that more private equity and venture capital firms, and especially folks that are doing angel investing, aren't taking advantage of opportunity zones. You got Section 1202, but there's complications on the qualified small business stock, right? There's limits on it.
Yeah, I don't qualify.
Yeah. And so on opportunity zones, there's none of that limitation. And so it's literally all place-based. And the place-based solutions we can usually solve for.
Nice. I'm looking forward to it, man. This has been great. So if you're watching this, listen to this, make sure you check out those show notes. If you're interested in raising capital, setting up a fund, anything like that, or if you have capital gains and you don't want to have to pay a bunch of taxes later on, go check out OZPros. Really excited to learn even more about this myself. So Ashley, thanks so much for being here. Really appreciate it.
Thank you, Jeff. Been an honor and a privilege, and look forward to working with your listeners.
Absolutely great. Wonderful. And for those of you guys out here still watching and listening, make sure you tune into the next episode, like, subscribe, and share. Take care.